For more Fed reaction, let's welcome in now Kevin Gordon, Charles Schwab, Director and Senior Investment Strategist, and also back with us in studio is Gregory Daco, EY Chief Economist. Greg is the resident economist on the panel here. Let me get your first takes. What did you make of what you heard from J Powell there?
Well, I think there were a few interesting remarks here. I think number one, there is increased optimism about the economy. There is still this sense that we're headed towards a soft landing. Powell was very clear to signal that there's no victory against inflation, but we are moving in the right direction. The second important takeaway is that he made sure to highlight the fact that the changes to the statement were not necessarily as hawkish as we initially thought. The removal of gaining greater confidence that the economy is moving towards 2% inflation and further progress towards inflation, those might have been seen as potentially hawkish. Powell made sure to say that this wasn't necessarily a sign of more hawkish policy, but instead a test in terms of the forward guidance. We don't need to see further progress. We're moving in the right direction, and we don't need to see any additional progress in accelerating disinflation.
And Kevin, is the market happy that J Powell is going to stay the course, that there don't seem to be, at least initially here, and that the message was, I'm here to stay until my term is up in May 2026.
Well, yeah, because I think, for the most part, and with all the flack that the Fed has gotten in this cycle, one thing that they've been really consistent on is being data dependent, whether we like it or not. I mean, I think Powell has done a good job of navigating a really tough backdrop over the past several years. Yes, you could, make the argument that they were late in raising rates, but they've already talked about that and they've already admitted to it. I mean, I think that the best way to be an ex-post Fed where you're really looking, month to month based on the data coming in is being transparent about the fact that, you really don't know, especially when you're so supply shock prone in this environment, which makes this so much different than any other period we've seen. And you add in the prospect of, more policy uncertainty for 2025, especially on the supply side, whether it's labor or whether it's tariff related. I think that really, probably hamstrings the Fed and makes their job a little bit tougher. It's way too, premature to look ahead a year from now and say where we're going to be from a tariff perspective or from a labor immigration policy perspective. But to your point about taking out the inflation statement regarding confidence of the statement itself, I think that is a way of this Fed at least preserving optionality for not only, maybe not December, but maybe for the full year of 2025, and just, again, admitting that the clarity is just not there in what it used to be maybe pre-COVID.
Greg, there was a question that was asked, and I want to get your take. They were talking about what we're seeing with yields, and the reporter asked, are you, J Powell, is that because of expectations for stronger growth, or is it rising deficits that's caused it? I don't think J Powell wanted to weigh into that too heavily. It's not, but as an economist, how are you thinking about that?
Yeah, I don't think he necessarily wanted to dive into the decomposition of why yields are rising.
Right,
I think there are a multitude of factors behind the rise in yields. There is expectations of stronger growth. There is also expectations of stronger inflation. There's likely a term premium, and there's also expectations of larger deficits. So it's all together that those factors are pushing up yields. I think what was very interesting was his response to whether he and the Fed would lean against this rise in yields because it leads to tighter financial conditions. And his response was very clear. This tightening of financial conditions needs to be persistent for the Fed to react. So far, it's not been persistent. He actually alluded to what happened last October, when we saw a similar run-up in yields, and then a couple of weeks later, yields fell back down. So I think they will want to see the dust settle in the next few weeks to see whether there is persistence in this rise up in yields and this tightening of financial conditions, and really what is driving that. It doesn't seem to be a de-anchoring of inflation expectations, for instance.
The other thing that I think is interesting, and he referenced, and you just referenced the 5%, or close to 5%, maybe for a day that we got to for the 10-year, but that was consistent with an equity market correction, a full-blown correction for the S&P 500. This time, the rise in yields has occurred in conjunction with this really strong rally across risk assets. If you're just looking at yesterday, typically that kind of move in yields that you would see, like we saw yesterday or over the past several weeks, would not be consistent with a rally in small caps or a rally even as strong as we've seen in the S&P 500. It's that magnitude of the move in yields that tends to put downward pressure on the stock market. So it's interesting because, at least for market-based financial conditions, yes, you get a tightening if yields are going up, but it's typically not consistent with the tightening if you're also seeing risk assets go up. It would typically be the opposite direction. That's why financial condition indexes yesterday didn't didn't really move aggressively in one way or the other because you had that offsetting pressure from rising yields but also rising stock prices. So I think that's probably a more interesting thing to monitor. What level of yields ultimately does trigger maybe a little bit of a problem or an issue or a sell signal for equities.
Is there a level you'd be watching?
I mean, 5, I think, is the one precedent that we have. It's a sample size of 1, of course, so it's hard to say. I do think that the rate of change matters much more than the level, but of course, if we're going to be dealing with a persistently high level or maybe an elevated floor, whether it's for inflation or whether it's for bond yields, that's a little bit of a different story because the disinflation story has been so strong up to this point. But if things were to change based on, again, labor policy and/or tariff policy, I think that would be, more of a material mover for the market.
Let's talk a little bit more about the elephant in the room, Donald Trump. I think he's going to be the elephant in the room for the next 4+ years, right? When it comes to the markets and economic policy, Powell was very careful to say, we don't know. He didn't say this explicitly. But effectively, he said, we don't know what he's going to do. We don't know what effect the economic policy is going to have. We don't even know what economic policies he's going to put into place. The market has kind of decided that it's going to be great, right? That, if the market's a discounting mechanism, it seems to have made that decision. Like how, as somebody who's setting some strategy here, Kevin, how do you think about all of
it's interesting. I was looking this morning at, if you go back to 2016, right after Trump won, the period from the election to up until Inauguration Day, you did have this really strong rally and the so-called Trump winners, which have been actually almost the same industries, sectors that have been rallying at this point. If you go the year after that, those were actually the underperformers relative to the so-called Trump losers. So I think it's part of a broader story and what we always try to relay to clients, where you can't necessarily make these sector calls or industry bets on what's going to do well, especially this early in the game, in the stage of the election. We haven't even gotten to Inauguration Day. So I think that's the main message here, where you can't just take one day and extrapolate it. Even if you were to look at some of the internals in the market yesterday, breadth for the S&P was good. I mean, you were positive, but it wasn't exceptional and not nearly consistent with what you would see for a market that was ripping more than 2.5%. That's not inherently a bad thing, but you do have to consider the fact that it wasn't necessarily an everything rally. A lot of what was rallying and leading the market has been lagging so far in the first couple of years of this bull market, was certainly lagging in the first year of the bull market. So I think that's an important context.
Greg, you must be getting questions from clients about the Trump agenda. And listen, we don't know, to Powell's point, we don't know exactly what's coming up. We know what Trump emphasizes, right? It's taxes, tariffs, deregulation. But what are you telling clients when they ask you that?
Well, I think it all depends on what is going to happen over the first 100 days and then what's going to happen at a later point in time. We were talking earlier about the fact that a lot of the potential changes to tax policy and trade policy will have an effect towards the back end of 2025 into 2026 and 2027, so not necessarily immediately.
And the tough part is, Greg, there's so many different variables, because if you're talking about tax cuts, is it going to be like a one-size-fit-all corporate tax cut? Because sometimes you'll hear Trump allies and they'll say, no, we're talking about something more targeted. You want a tax cut, you better be about U.S. jobs, U.S. manufacturing. I mean, it gets complicated.
Well, the one thing we know on the tax front is the expiry of the Tax Cuts and Jobs Act. So a lot of household income taxes are going to go back up if nothing is done at the end of 2025. That will be something that will likely be prolonged. How long, how broad it is an open question. But with Republicans having control of the Senate and perhaps even of the House, there's a greater likelihood that we see a full or near full extension of the Tax Cuts and Jobs Act, maybe not for 10 years, but maybe for 2 years or 5 years, that essentially keeps tax rates at a lower rate. The key important fact here is that it's not a tax cut per se. It's a prolongation of existing tax cuts. The other question that's important for businesses across most sectors is whether there is sufficient momentum to drive the corporate tax rate lower. That's not changing. That's currently at 21%. So is that going to be brought down to 15%? And then questions like bonus depreciation, R&D expensing, those are key for businesses to drive stronger investment. And those are opportunities actually for stronger growth going into next year.
So when you said first 100 days, it reminded me, Julian Emanuel of Evercore ISI, out today with a note. He said in the first 200 days, I believe, we will see the S&P 500 get to 6,600. Does that make sense to you, Kevin?
I mean, momentum is a powerful thing. So I think if you were to continue to see the kind of momentum that we've seen this year, which so far the factor of momentum for the S&P has been having its best year since 1999. So you can certainly see that. To me, it would be more important to look at what's getting you there. Is it a resumption of the trade that you had for a good chunk of 2023 into the first half of 24, where it was a smaller group of stocks, not just 7, but a smaller group that was leading you there, a significant increase in the number of members that were underperforming the index. That has clearly flipped since the midsummer, and I think that's been the best part of the market backdrop since the midsummer. So if it was that backdrop, then I think that would be an all right thing. I think it's just way too early to tell. And I do think that from a valuation and a sentiment perspective, if you were to combine those, given the fact that we are in relatively frothy sentiment territory, and you're also seeing valuations that are stretched across the board, across virtually every metric that we track, that in and of itself is not a risk for the market to just turn imminently lower. But it does, sort of increase the vulnerability of the stock market in general in light of a negative catalyst that approaches. And that's sort of to be seen, especially as you're going through a transition for the administration. But that just shows you that the playing field that we're now on is just a little bit more vulnerable than where we were.
Do you think, Kevin, there's probably some viewers who are watching right now and they've seen the action in the markets the past 24 hours. I've got green on my screen again today, and they're thinking, what, maybe I should be restructuring my portfolio. Good idea, bad idea?
Well, I'm always in favor of doing it based on what your needs are. We haven't been as much in favor of calendar-based rebalancing because there have been so many volatile swings across asset classes, but even within U.S. equities, within sectors. And so we've thought that taking advantage of those, maybe about letting your portfolio tell you, not the calendar tell you, makes a lot of sense. So if there are areas that were moving strongly yesterday where you felt underexposed for a good chunk of this bull market, which a lot of investors have, because you look at stock versus flow, the stock of areas like tech is still really strong. The flow has come down a little bit. We're not yet seeing this massive flow and surge into the more cyclical parts of the market, but that to me would make more sense if you were trying to get more exposure, especially because even with the strength that you've seen over the past couple of days for a sector like tech, the leadership shift that has happened since mid-July has been pretty amazing for the rest of the market. It's not that tech has dramatically underperformed and has even fallen. It's just given a lot more runway for other sectors to start to participate, and I think that's been a relatively bullish backdrop.
Guys, thanks so much. This was fun. Appreciate it. Kevin, Greg?
Thank you.
Great to be here.
Have a good one.